Thank you very much for joining. I think we wait another minute or so, so just 3 more people can join, and then we will start. Okay, so I think we can start now. Hi again, everyone. Thank you so much for joining us today, and welcome to the 6th event in Climate Change AI webinar series. My name is Rafaela Kotsch. I'm a PhD student at the University of Zurich, and I'm also a member of Climate Change AI, where I am the community lead for economics and markets. So let me see. So for those of you attending your first event from Climate Change AI, we are a global organization that fosters impactful work at the intersection of climate change and machine learning. And we provide various digital resources, education, and infrastructure for those who wish to work on climate change and AI. And we advise relevant stakeholders and run events for knowledge sharing, community building, and advancing conversation in this field. So for example, if you're interested in getting a general overview of the field, I recommend to check out the CCAI website to access interactive summaries of different applications of AI to support climate change, mitigation, and adaptation. And I would like to draw your attention to our new wiki, which you can access through wiki.climatechange.ai. And you're very welcome to contribute or even take on the role as a moderator here. If that sounds interesting to you, feel free to reach out and we can add it to our CAI Wiki Slack group. So we also host a lot of events and workshops at conferences. If you want to get a sense of where the field is going, we encourage you to check out our workshops highlighting the latest work in this thematic area. And we run these throughout the year. You can also find videos of past events online. If you're looking to cooperate or to just meet others interested in the field, you can also check our bi-weekly happy hours. The next one will be on Wednesday next week. You can check out our discussion forum or all the many other opportunities and resources available on our website. So you can also subscribe to our monthly newsletter, which includes calls for funding, submissions, and links to readings and courses. And we also have a new community platform on Circle. So Circle is a bit like Slack, but I was told it's even better. So we will post the link to join the Circle community here in the Zoom. So you can just click on the link and join us. With that, I move forward to the next slide. Today's webinar will be a roundtable discussion. So we'll have a bit different format than previous webinars. And we will also have a Q&A session at the end. So please just put your questions in the chat. And with that, I hand over to Arpit Narain, who will be chairing today's webinar. So Arpit, the floor is yours.
Thank you, Rafaela. Good morning, afternoon, and evening to everyone, depending on where you are. To my brief introduction, my name is Arpit Narain, and I'm the Global Head of Financial Solutions at MathWorks, the company that makes MATLAB, responsible for the worldwide expansion of quant modeling and AI solutions across different domains, including climate risk, ESG, derivatives pricing, financial risk, investment management, and AI model governance. And it's my absolute pleasure to actually host this panel where we have senior climate finance experts as our panelists, representing industry, academia, and intergovernmental organizations. And the objective of today's event is to discuss the application of AI in data analytics and climate finance, as you would have seen in the marketing materials as well. And through the sessions, I'll actually ask a series of questions based on key themes in climate finance to our panelists, and would ask them to share their views on that. And given their diverse background, I'm very confident that they'll share multidimensional perspectives on the topic. So just stay tuned through the end, and I'm pretty sure you'll gain some valuable insights from this session. Now, just to set the context before we actually move into the questions for the panelists, we all know that it requires no debate that the impact of climate change will have substantial impacts on the macroeconomy, which will lead to sizable impact on the balance sheet and the operations of financial institutions, leading to big climate-related risk and opportunities. On one hand, we have loan portfolios where the underlying properties may be located in the coastal areas, which could be exposed to the physical impact of climate change, such as rising sea levels, flooding, and whatnot. And the lenders need to make sure that they adequately assess the risk and losses related to such physical impact and mitigate those accordingly. On the other hand, though, there's a need for massive capital and new products that are needed to fund the transition to the greener economy in line with the Paris Agreement goals. And this will create new demand for the banking products and services alike. Now, the regulators have already started to act, and the investors, lenders, and the other stakeholders, they are expecting adequate actions and transparency on this particular issue. Now, meeting these expectations requires several things. The business and the regulatory expertise is crucial. However, analytics is playing and will continue to play a big role in assisting these experts in making optimal decisions, whether to mitigate the risk or to seize the opportunities that the climate change is presenting. Now, I spoke about analytics. Analytics is a broad term, right? On one end of the analytics spectrum, you have traditional computational, numerical, and statistical approaches, which are proving very useful currently in modeling the financial risks in the financial institutions. And on the other end of the spectrum, there lies the entire world of AI and machine learning and data science, which has also started to demonstrate some promising value to the community. And there are a variety of use cases to those, some of which we'll discuss in this webinar. And having said what I said till now, forms the basis of today's panel discussion, which is the application of AI in data analytics and climate finance. Now, as it goes to the dynamics of this panel, we'll start with the introductions of the panelists, followed by the series of questions on some of the key topics, which we'll actually ask our panelists to share their views on. And depending on the time remaining at the end, we'll actually address the questions posted by the audience in the chat. So for the audience, feel free to post the questions as the session is going through, but we'll address those through the end. So without further ado, I would pass it on to the panelists to make their brief introductions, and maybe we can start with David. David, off to you.
Great. Thanks so much. It's great to be here. Hopefully you can hear me all right. And as I said, I think that this is such an important topic, and I'm coming at it from the financial sector. So my work is at the UN Environment Programme's Finance Initiative, known as UNEP-FI, and I lead climate risk programming as well as TCFD piloting for a number of global banks as well as investors. And it's my focus and desire to see institutions come up with the right tools, the right data and insights, both to manage climate risk, but also to accelerate the transition to a low carbon economy and build resiliency in the face of climate change. So I think this topic is, very much a next frontier for risk management generally, but of course for climate specifically too.
Thank you, David. Natalia, do you want to go next?
Hi, hello everyone. Likewise, I'm very happy to be here, and I would like to thank Climate Change AI for organizing such an important and interesting, compelling discussion, which hopefully is going to be very fruitful. And also, yes, I would like also to thank for inviting me to take part in this discussion. So I'm Natalia Tkachenko, and I am a postdoc at the University of Oxford. I'm part of Oxford Sustainable Finance program, and I am also AI and data science lead in the group. I am also a visiting researcher at the Alan Turing Institute Sustainable Finance and Economics program, and where we're also discussing a lot how new tools and emerging technologies can help financial institutions to address various problems posed by climate change, environmental degradation, and a decline of natural resources. Yeah, and I also recently become a Google Impact Scholar. So I received a funding from Google for investigating how AI can be helped to scale up various conservation tools to help and protect various critical habitats in various parts of the world. Thank you.
Thank you, Natalia. Chinmay?
Sure. Hi, everyone. Very excited to be here. I'm Chinmay. I'm the CEO and co-founder of EarthLab AI. At EarthLab AI, we provide water risk intelligence, especially focused on floods and droughts, to insurance companies, infrastructure companies, and governments. And the way we do it is using satellite data, climate modeling, hydrodynamic modeling, as well as AI. And I'm very excited to be here and talking about this topic along with other experts. Thanks.
Perfect. So hearing the introductions, you might have realized the diverse backgrounds and the deep expertise that the panelists bring to the table. So, without wasting any time, I'll jump into the key topics for the panel discussion. So when it comes to AI and data analytics across any discipline, probably the most obvious and the interesting aspect is the use case within the domain of interest, which in our case is climate finance. Now, we are witnessing some tangible success with the use of AI and data analytics in climate finance, from the application ranging from the application of statistical machine learning algorithms in generating transition risk scenarios, which are used by financial institutions to assess market risk and credit risk, to the use of text analytics in actually analyzing the news articles and financial disclosures, which is used in investment decisioning, to the application of computer vision in analyzing the satellite images to identify physical risk. So the application area is broad, and that leads to my first question for the panel, which is how AI and data analytics can help in seizing opportunities and managing risks related to climate change. And it would be great if you can actually provide a relevant use case as an example. So maybe we can start with Chinmay on this.
Sure, definitely. So currently we see two huge areas for the application. One is on the opportunity side, as you said. And in this case, a simplest example would be if you are doing a new renewable energy project, you need to understand what is the physical risk to this project, because you need to make sure that it's underwritten correctly. But also a lot of these projects are financed on a multi-year finance deal. So you also have to understand like what is the return, possibility of return for a specific renewable project. So this is where AI can be very helpful in terms of projecting future energy generation potentials or future physical risk. For example, in the US today, a lot of the solar projects are under huge scrutiny because of the hail risk, because there was a huge hail damage in Texas to a major solar power plant. So this is where AI can be very helpful in site selection, as well as quantifying the risk for today, as well as in the future for financing. And on the risk side, it's very similar. A lot of the risk we have today has materialized itself as operational risk, which means we are already building some sort of business policies around it. So this could be setting aside money for floods, or setting aside money for hurricane damage every year, all the way to like, okay, should we actually be making this factory here? or should we actually be creating this multi-housing unit in this area where the flood risk is very high? So this is another area where AI can be super helpful and start helping us figuring out these kind of risks. So, yeah.
Perfect, and that makes absolute sense, Chinmay. You spoke about the opportunity, talking about the physical risk and the returns associated with that, and then you spoke about the operational risk. And it comes with no surprise that operational risk is an important risk. The insurers have been managing that. The banks have been managing that as the part of Basel AMA regulations as well. And the same thing now needs to be transformed and applied to climate finance as well. So thanks for sharing that insight. Natalia, do you want to share your views on this?
Yes, thank you. I agree that AI and ML has a kind of tremendous opportunities in the field as a helpful assistive technology across multiple dimensions, and also, for example, it can scale up this analytics, which Chinmay just mentioned about. So in estimating physical risks, also transitional risks as well, due to various climate-related policies. But also, I think I also would like to mention a slightly different angle, which is not being mentioned very often, is a complexity. So AI and ML, obviously, they are very good at handling complexity, and there's various types of neural nets which can handle this complexity, and the risks, they not necessarily take a kind of obvious position. So we need sometimes to identify where risk lies, how it's being mediated, how it's being moderated, how it's being multiplied and amplified. So AI is also a technology which can handle this incredible complexity which natural kind of world and climatic system represents. So also I would like to mention that natural world, environmental kind of system, they are quite unknown for financial institutions. It's something new. And so for them to deal and scale up very quickly and provide models which are kind of capable of producing comparable results. We're talking here even global models, because we're talking about global economies, global transitions. So comparable results, AI is something which could be a great answer to that, because it will help to quickly scale up, produce outputs, at least speed up the process, which data production process, useful data production process, which I would like to reckon that I mean, GIS and various other statistical approaches, they've done a great job in mapping and etc. However, we need more. We need more data. We need more granular data, better data, and also at a very, very big scale to be able to answer and tackle all these problems and questions.
Absolutely, absolutely. And you mentioned neural networks, right? And we have seen time and again that neural networks are bringing in efficiencies because they can handle the nonlinearities, the interaction of variables, and a lot of other complexities really well. So great to actually hear those insights from you, Natalia. David, do you want to actually share your views on this?
Yeah, so I think of the role of AI being pretty widespread. In the sense that climate is really, at its heart, a very complex, computationally intensive, multi-factor problem, going all the way upstream to the physical climate models, looking to assess different, essentially, cubes of the atmosphere and the land surface, and how they evolve relative to their neighbors, realizing that that is a massively computationally intensive process, and that there are huge amounts of data involved, really does suggest that there are avenues for AI and for machine learning, both unsupervised as well as supervised, to play a role here. I would say on the physical side, I think that's where there's more of an obvious connection, and that's where pieces like remote sensing, but also learning as far as impacts. And one of the challenges is in preparation. So in terms of knowing where storms will materialize, this is still an early area of work, but one that I think is particularly critical to creating better early warning systems, creating better understandings of future expectations. Then there's also just the interaction effects between different hazards, and recognizing the nonlinearities that result from a multi-hazard set of events? Is it a storm with winds that are blowing in and thus increasing flooding? Is it a fire, but it's also happening at the same time that there is a heat wave that is putting extra load on the grid? These are the kind of multi-hazard challenges that exist in the real world, and I think often have been modeled separately, but I think with greater analytical capabilities can be modeled together. Just switching over to another type of risk from some really interesting work that's been done on the back of the historic heat wave in the American and Canadian Northwest. The attribution science space is one where data analysis is critical to think about how climate has changed the odds, and also from a legal standpoint can really be a sea change in the sense of how the world understands blame and understands causation. And I think that will have major implications for legal risk, and it'll have major implications for those looking at their financed emissions and the relationship between those emissions and the causes of extreme events. So there's so many more areas, but obviously to give a chance to move on in the conversation, I'll hand it back to you. But I do think it's a very fertile field for this type of analysis.
Absolutely agree with all what you said, and you brought in like so many good points here. You spoke about like big data existing there, but how can we actually do an efficient descriptive analytics? Then you spoke about how we can actually build early warning indicators by doing some predictive analysis, and not just that. This is a multidimensional problem where there's dependency relationship, and how do we analyze that multi-dimensional relationship? And finally, you spoke about causation and attribution analysis, which is again extremely important to understand what is happening and why it is happening. So all are great points. Thanks for sharing those, David. Now, having spoken about the use cases, we know that one of the key determinants of high-performing AI algorithms is the availability of right and adequate data. And one of the big challenges in climate finance is the lack of either the sufficient volume of data or the right quality of data, which impedes the development of robust models in the space. And that leads me to my next question for the panelists, which is, what are the data needs to apply AI and data analytics in climate finance? And what are the associated challenges and considerations related to sourcing and treatment of this data? And maybe we can start with Natalia this time.
Hi, thanks for this great question. So I think I'd like to separate here kind of two things. So first of all, so data, raw data, and the data which we can obtain, information, useful data, which will help financial institutions to make decisions. I wouldn't say there's abundance of raw data, obviously, and also this is also one of the reasons why we should be using actively machine learning and AI technologies, because we need to make sense out of this wealth of data. So we already mentioned important kind of challenges like attribution, and also understanding the extents and where various value chain elements function on the planet, etc. All the data sources which are capable of capturing localization and work of these assets, they already available, and we have multiple kind of satellite data sources of various resolution, both spectral and temporal, and spatial as well, which will allow us to answer all kinds of questions and capture all kinds of activities. But also I'm talking about apart from physical data and physical measurements, we also have various heterogeneous data sources like social media data, unstructured text, web data, which is also can be quite useful in helping to understand people's reactions and human sensing as well. So I would say that the data needs of raw data pretty much satisfied. It's just how we tackle this data, how we extract useful pieces of information out of those data sources is this is where AI can step in. And obviously from my experience, quite a wide array of AI techniques, and as I mentioned already, neural networks, my favorite topic, can help us play with various data sources and kind of mix different data sources and fuse them, augment data sources where they are not necessarily sufficiently covering the problem. Yeah, I think the question is here for me, and I probably would like to hear what other panelists think as well on this account. But I would say that there is no, we have a lot of raw data. We need to learn with help of AI and machine learning how to extract useful information adapted for various financial institutions for their needs and their plans and activities.
Perfect. So you spoke about extracting the right information and signals from the existing data. That could be like structured data in crude form, the traditional type of data, or it could be alternative data like the images and the text analytics data from news and whatnot. And you mentioned about neural networks, which is your favorite topic, and so does mine as well. I also agree there could be a lot of applications of deep learning and neural networks and actually identifying and extracting signals out of this raw data. So thanks for sharing those insights.
I just wanted to add additional point that I think primarily I mentioned here is also something which is called remote sensing, but also I don't want to undermine the importance also of the site measurements as well, and also various site measurement networks. So I think AI can also help here where we cannot, some of the things we cannot measure from far with help of satellites. We also need to go in the field and do some sampling ourselves. So I think AI even here can help in machine learning to understand what are the areas, what are the priorities, how to target these observation networks, where to install sensors, what kind of information they should be sampling for us. So AI even here can be quite efficient.
Gotcha. All that makes sense. David?
Yeah, I think the data question is interesting, and it reminds me years ago of being studying history and thinking about the ancient past and how many manuscripts we only have fragments of, and thinking about in the future the challenge will not be how do we find the last remaining manuscript, but how do we wade through all of these versions of the truth, quote unquote. And I think today in the financial space, we are increasingly running into this problem of understanding what data to use is as important as the types of transformations and applications we use of it. So knowing where the points of truth are, I think are really critical. And one of the things I would say is it's important not only to think about the processes around ensuring that the data is sensible, but also what exactly is the data saying, and do you have people within your organization that can understand what is needed? I think very often there's sort of, and I've seen this from regulators and I've seen this from financial institutions, a view of just give us data. Well, what are you going to do with it? I don't know, but if once we have it, then we'll figure it out. And I think that in a lot of ways, that sort of undirected search can be somewhat of a time-consuming and resource-consuming enterprise, whereas having a clear objective and then rewinding to what are the pieces that are needed, and we may need to explore multiple data sets to get there. But I think very often the structuring of the exercise, where do we want to come out, I think is really useful. And so if it's to assess your physical risks, if it's to assess exposures to transition in a given region, these are questions that should inform where you're looking. And I think that being a bit more savvy, not only about what the sources are, but what the actual data itself is, what it can and can't say, will allow us to find that right balance between information and intuition. And I think that balance is critical to strike in building anything that is a meaningful and decision useful framework.
Can't agree more. And your terminology of information and intuition balance, I think that's one of the most important things that the data science community should also realize. You can get a lot of data, you can actually generate a lot of patterns, but is there a causation between those patterns? Is the X variable causing Y variable to change or not? That's important. And that's where the business expertise is very important. And you mentioned two things, knowing where the point of truth is and knowing what the data and the relationship means is extremely important. So it's more of a collaborative exercise between the data scientists and the core business experts and whatnot, which will make it successful. So thanks for sharing that, David. Chinmay, would you like to go next?
Sure. So Natalia and David, they both bring up very important points, and I'm not going to elaborate on those because they're already covered. One of the areas where we have seen challenge in our own work is geographical diversity of the data itself. Humans have done a very good job in measuring our environments, at least in developed countries. So a simple example is water gauge data. So USGS in the United States, they measure water levels at various river systems. They have been doing that since 1970, and a lot of that data is available. But if you think about the risk related to water, it's quite large in Southeast Asia and parts of South America. There, we don't have this kind of data. And to Natalia's point, even if we have remote sensing data going back all the way to 1970, unless we have the ground truth data to really verify what remote sensing is seeing, we are not going to have very comprehensive models. So that's one area where I'm really seeing the challenges and need for more data. So either improving the collection or repurposing the old data to get more insight, to David's point, to really understand, like, okay, was this really water or was this really flood here? Or just because the presence of water doesn't make it a flood. So those kind of nuances we need to start figuring out, because AI models can tell you a lot of things, but at the end of the day, we need to interpret them and apply some sense to it, and make a good use out of it as well. So yeah.
Absolutely, absolutely. So, improving collection and repurposing the data the right way are two important themes you mentioned, and all of that makes sense. So thanks for that. Moving to our next topic, we all know that there's a lot of research available in AI space across all disciplines. See arXiv, see a lot of other internet sources. There are research papers coming, there are blogs coming, and there's no lack of it. But the problem is the conversion rate to the real-time systems. The banks are facing huge challenges to convert the R&D to the actual real-time systems. And that's what forms the basis of my next question to the panelists, which is, what are the typical challenges you see in moving from the lab to real life in climate finance space? And Chinmay, maybe you can start on this one.
Sure. So one of the biggest challenges from the industry side we have seen is reproducing a lot of the results from various research papers or conference papers. And what we have found is it's not that those results are not valid, it's just that making them more generalized has been the challenge. And that kind of goes back to my earlier point about lack of diversity in the data sets that we use to train our AIs, but as well as not having enough understanding of diversity within like the cause and effects of things. A very good example is coupling of wildfires and floods. So if you look at floods happening in Arizona in the US, a lot of times they are right after wildfires because there's no vegetation on the ground to really stop the water. So you can have flash floods because of that. But this phenomenon is very unique. Now Mongolia has a similar phenomenon, but it's something different where the frost can cause floods because it kills a lot of the vegetation or the grass on the ground, and that can cause flash flood. So now if I take a research paper or a model that did model this phenomenon in Arizona, I can't really apply it or generalize it to Mongolia. So these are some of the challenges where we are focusing our research on very limited scope or limited area because it's easy to produce those results. But we need to start expanding it as well because greater need for AI in this case is going to come from areas where we don't have a lot of data. So we're going to have to either generate the data or figure out ways to model it. So yeah.
Perfect. And you remind me of Freakonomics, how the author connects like different things in the society to model impact of something on the other thing, which is completely non-obvious. And you mentioned about reproducing results is not that difficult, but generalizing the results is, and lack of diversity of data or lack of understanding of causation is the real challenge. And I can agree more to it. Natalia?
Yes, so I would like to echo Ajamai's points about a lack of validation and ground truth data in some of the regions. So we need obviously some more balanced data training data sets and validation data sets. But also I would like to mention something which is also came across in my own work. So even the data sources which we think have a kind of perfect coverage, like satellite images, they're still not really covering everything equally around the world because of the kind of various cloud coverage and also various seasonal factors which do affect the way a data is being sensed. So we're still talking a lot about heterogeneity here of the information, even raw information, and even of data is which is expected to be quite homogeneous. So another question is obviously take into consideration also kind of much broader types of data sets, because when we're talking about sustainable finance, we obviously not mean only environmental factors, we also mean social factors, social deprivation. So how also try to consider both social and environmental interactions also in the models. It's also can be quite important. These models are emerging, but they are still quite rare social environmental models. So yeah, segmentation of regions based on the social attributes is also quite important aspect. Yeah.
Great. So data coverage, lack of coverage is one of the problems, and then you said modeling the social and environmental interactions, again, one of the important things. Thanks for that. David.
Yeah, sorry, was just needed. I would point out two things that immediately would jump to mind on the kind of how do we go from the lab to the real world. One is the recognition of climate as a chaotic system, and this is something, of course, that has bedeviled everyone from weather forecasters to climate modelers. And the more we zoom out, it's kind of like one of those impressionist pictures, right? The more we step back, the clearer the picture is. It's incredibly obvious what is happening at a global level. But the more we zoom in to each of those individual brushstrokes, the tougher it becomes to say, on March 27th, there will be a flood in such and such place. And I'm not sure we will get to that point, at least not in the near term, but I think it is an important recognition that certain processes that are chaotic, building robustness in the outputs means thinking about what sort of either simulation-based approaches to give probabilities or levels-based approaches for average damages across different probabilities are necessary in order to say something meaningful that is repeatable. I think in this case, we can often suffer from, especially for those who are less familiar with data limitations, the fallacy of over-precision, that we know exactly what these hazards will be and their likelihood. We don't. We do understand a distribution of them, and I think that that's important. The second piece, though, is maybe a bit more of a practical one, which is the translation exercise. I've tried to tell people that fundamentally all of climate risk work is translation. It's translating climate factors into understandable financial risk drivers, and then thinking about how they apply into traditional categories like credit risk, market risk, operational risks. But it's not that climate risk sits apart from those, but is a key input into each of them. But fundamentally, that means having familiarity with how these different climate factors influence and become drivers in terms of the financial well-being. And that becomes a tougher thing because I think a lot of the literature on the physical side has focused on incidences, on severities, but the actual first order and second order economic effects are ones that are increasingly being studied, but bring in, similar to the first point about chaotic systems, bring in a lot more new variables. So how do we generalize the economic damages of a Katrina or a Harvey? How do those differ when they're in a developing nation? How do they differ in terms of where on the coast they hit? And what is the 1 year, 5 year, 10-year changes in economic health and performance? So I think those are, to my mind, the two big areas. One, just the inherent nature of climate as a chaotic and immensely complex system, but two, the translation into the meaningful quantities that are necessary and discerning those relationships between the drivers and the outcomes.
Yeah, and you segmented the overall spectrum of the problems you mentioned in really good way, talking about chaos and the mapping of the climate variables to the financial variables and the macro, and determining the macroeconomic impact. Spoke about robustness, the policy of over precision, the type 1 error, and so on and so forth. I agree that all of those things are very important to be considered. So thanks for that. Switching gears to the next topic, we all know we are talking about climate finance, and so we are operating in the world of finance where regulations are very strict. It's not the entertainment industry, right? Moreover, the policymakers globally are working very actively, individually, as well as collaboratively on defining policy framework for climate risk. The classic example of this is the NGFS, which is the network of 83 central banks and supervisors, which is actually formed to develop recommendations for central banks to tackle climate change. Now, these regulations and policies will directly impact the financial institutions, so it's very important to understand them. Which takes me to my next question, which is, what is the current landscape of climate finance regulations and policy, and what leverage AI and data analytics provides in addressing these regulatory and policy needs? And David, we can start with you on this.
Yeah, so on the regulatory side, this is an issue that I think had been for the last few years skirting around the margins of regulation, and picking up some steam, but going back to the TCFD's initial issuance in 2017, I think it's been largely a private sector driven initiative, and it's only been recently that regulatory focus has turned to it. We've just seen a large number of reports from the Commodities Futures Trading Commission, CFTC in the US, to the EBA and ECB in Europe, to the FCA in the UK, to reports from the Bank of China, from places like New Zealand as well, not just on regulation, but on a recognition that climate risks pose financial risks, and as such need to be managed. And the mandate to maintain financial stability extends to a mandate to balance the climate risks and challenges with some of the more traditional functions of a central bank and a supervisor. And I think this is where a lot of the standardization and comparability efforts are ongoing, which is to say, how could we understand the financial position of a company if people reported in very different ways and some didn't report? So there's a bit of clarifying what these standards are, but behind that is also what are the common assumptions that are being made? What is in the toolbox or in the toolkit? And the goal is not for everyone to use the same scenarios. It may be the case to do that for stress testing. It may be the case to do that for some external reporting, but people have different idiosyncrasies, different needs. And so the variability is not a bad thing, but I think consistency and comparability are critical, even in using different scenarios, even in thinking about different models. And I think that regulators are moving relatively quickly, first to mandate disclosures, but then to move into more impactful regulations on capital. And while that isn't immediately coming down the pipe, it's hard to see stress testing not having some impact on things like risk weighting, some having not, some having more of a view of alignment to existing taxonomies like the EU taxonomy. And I think all of that is built on the back of scenario-based data. Some of that can be very granular, locationally specific, but others can be more in the sense of macro drivers. But the main point is that I think a regulatory eye has been turned toward the topic, and it needs to be particularly picked up by those supervisees who are the ones now that need to both do this in order to manage their risks, but also to meet these emergent demands.
Yeah, and the point you brought on standardization and comparability is extremely important. And, you know, I've seen people using the same data to model the same problem with the same amount of idiosyncratic data, but producing different results. So we have to bring in that standardization, and their efforts, like IASA is building this scenario database so that people can use like standard scenarios. And there are a lot of efforts going on, some of which you mentioned as well. And I agree, those are very important. So thanks for that, David. Chinmay, would you like to share your thoughts on this?
No, I would just actually echo the same thought. Standardization or need for it is actually quite important here. One example I can think of is in the insurance industry, for example, every state, at least in the US, they have their own governing body that would approve of an underwriting methodology. Something similar is lacking today for climate-related risk as well. To have that kind of, yes, this is a right way to look at the risk, because there are, as David mentioned, there are a lot of tools in the toolbox. And right now, it depends on a consultant or agency you work with for TCFD, for example, or any sort of ESG-related disclosure, how they want to report it, what kind of tools they want to use to report it, and how they want to draw that connection between the risk to the actual numbers. But then it's not fair because you're not measuring apples to apples. You're not giving the same sort of treatment to all the companies. And this is why like having some neutral approach would be very helpful for the industry itself, but also for the participant who are on the receiving end of this TCFD or ESG type of disclosure as well, which are companies or banks or whatever. So yeah.
That makes a lot of sense. So, you know, creating that standardization or comparability across the underwriting methodology, you know, how do we actually evaluate the impact of climate on those methodology, whether they're fair or not, whether they're biased or not. I think that's critical. And you know, climate finance, climate change is still a gray area. The regulators also starting to understand more, and eventually probably they'll reach there. So, but thanks for actually sharing that insight, Chinmay. Natalia?
Yes, so yes, I agree absolutely with the requirements for standardization and also to understanding kind of how we can increase transparency in those toolboxes in the ESG instruments and kind of unify various ESG providers and actors in the field. But I also would like to mention also how AI can help here as well from the other perspective. When, for example, we're talking about issues such as greenwashing. So when companies and different actors, they do report data, and sometimes they are, you know, intentionally or unintentionally, they cannot disclose wrong information. So there is also a possibility and opportunities for AI to use and think about what kind of data sources can help us to verify what has been disclosed, and how those kind of independent and neutral verification tools supported with computational power of AI and neural nets can help to get kind of uniform results and understand whether what has been disclosed is actually correct information. Yep,
and I love that overlay of AI in this area as well. You know, there's a lot of leverage that AI has within the regulatory landscape, and what you said makes absolute sense, Natalia. So we have 10 minutes now left, and I think it's the right time to move on to the questions from the audience. And I have the list of questions that Rafaela put together. Thanks, Rafaela, for doing that. So maybe we'll open up for the questions, and I'll go first in, first out, as Natalia put those together. So the first question for the panelists is, how are the uncertainties associated with AI predictions factored into decision-making regarding financial climate risk? For example, neural networks tested on arbitrarily defined test sets. Was the question clear, or do you want me to repeat it?
So, oh, sorry, I wasn't sure if you wanted it to go to Natalia or.
Yeah, it's open. You know, whoever wants to actually talk about
I'll let Natalia take it.
No, thanks.
You'd like to defer to me, but over to her.
So yes, thanks. I think it's a great question to which I also personally would like to have an answer. So I think probably because I'm positioned as an academic and I'm the tool developer, model developer, I probably won't be able to answer this, how it's being tackled in industry, because I didn't have that experience. So I would like to ask and hear David's opinion on what was his experience, how those decision-making tools actually tackled this problem. Sorry about that.
Yeah, I would just quickly say that I think dealing with uncertainty is the nature of being a risk manager. And if we had perfect information, we would be unnecessary in some ways as risk managers, because there wouldn't be anything unexpected to deal with. We would just make provision for the known the known experiences, and that would be that. But I think one of the keys is to think about both reasonability and credibility of the results. Sometimes models can tell us things that we couldn't see or weren't expecting, but very often we use them to apply, to my mind, rigor and specification to ingoing theories that we have. And so thinking about what are the intuitive connections, what are the loss levels that have been observed in severe cases, what are the experiences from insurance claims on physical damages. These are things that are never going to be a perfect analogy to the future, but can give us that ability to sense check and to recognize that there are going to be bands of inaccuracy. But one thing we can do is bias ourselves one way or the other to say, we want to hold extra to avoid being undercapitalized. We can make those decisions and they can have impacts on what ratings we hope to attain, what our risk appetite is. And so while we might not be able to control the error, we can, one, sense check the reasonability of the results, and we can control where the error is in the broader system to say, if we're going to miss, let's miss on the low side, or if we're going to miss, let's miss by holding too much in reserve. So those are the types of choices I think that come as critical to dealing with any uncertainty.
Great. Chinmay, do you want to share something?
I'm good, thank you.
Okay, cool. So the next question is, due to climate change and other factors, black swan, extreme events, never before seen weather, and market events are showing AI and ML models are vulnerable to overfitting to available historical data. How do you think about training models which still capture the risk of these events without biasing prediction accuracy under normal conditions? It's a long question. Let me know if you want me to repeat it or just give an answer.
I think I can start with this one. And it's very true, especially like the loss generating events are generally black swan events, where we actually have to worry about the physical risk or financial risk of it. One way to think about it is doing scenario modeling, that if this kind of black swan event happens, what is the outcome? What would be the outcome of this project, or what would be the impact on this specific asset or on the credit risk? So instead of trying to predict the black swan event, the way we try to look at it in our work is we assume that, okay, if this black swan event would happen, what would it do? What kind of losses it will generate? So that's one. The second thing is trying to create the probability of these black swan events based on certain factors. But again, by nature, these are black swan events, so you're not going to be super accurate. And then you have to go back to question one, as David said, how do you actually use the outcome of these models to make the right risk decisions as well? And at least in today's environment, with the current technology, this is how I have seen it handling. And this is how we internally manage it as well. So.
Thanks, Chinmay. Anybody else from the panelists?
Yes, I'd like to comment on this one as well. I think it's a great question, and also I think it all kind of touches also a little bit on the topic of are we doing modeling the same as we used to do, or are we doing slightly from a different perspective and adopting slightly different philosophies? Because black swans, and we're talking about here predominantly we are mostly indigenous systems. So when we are introducing AI, machine learning, all kinds of complexity modeling clusters of the novel type, will they be able to model and tackle multi-system systems? And will those multi-system systems and opening the system from inherently kind of endogenous towards exogenous, will it help us to better capture the complexity and also eliminate, but not necessarily fully, but partially, those black swans? This is also another question. But I think I'm a kind of very true believer in the power of this computational technology, which emerges and offers us wonderful opportunities. So I think that we will slightly have to think about how to design these prediction systems, but also kind of abandoning a little bit more what we were using before as a model design.
Great. David, do you have any thoughts or?
I feel like I've said a lot, so I'd love to give the floor to one of my co-panelists, if Chinmay wants to add anything on that.
Sure. I think we can then move on to last question, and maybe one of the panelists can answer that because we only have 1 minute. What are the practical barriers to AI-related work in your organizations that you have experienced? And anybody can take it. Whoever raises the hand first.
Okay, I can take it. And I guess everyone would agree probably. It's just finding the right training data. It's just pain. It's there is a lot of data available, to Natalia's point earlier, but also like, where do you start? Like recently we were trying to model flood extents in Africa. One would think that there's a lot of training data available, but no, it's incredibly hard, because then you have to start thinking about the nuances of it. Like, because we use radar data. In radar data, water and tarmac or a road has similar signature. So how do you generate training data for that kind of model? So it's just one example, but I think that has been one of the biggest practical pain points so far, at least in our work we have seen.
Perfect. And we have discussed a lot of other barriers as well. I think that question got answered pretty well throughout the session. So thanks for that. So to wrap up the things, we understand that the impact of climate change in financial services is a hot but niche topic, and the overlay of AI in data science makes it further niche. And that was the core of our today's discussion. We heard from our panelists different use cases, data and implementation challenges, regulatory and policy landscape, and a lot of other associated dimensions. I hope the audience found the insights shared by the panelists very useful and would be able to leverage this in some or the other form in their work. If you have any further questions, please do not hesitate to reach out to CCAI, and we'll be glad to address any remaining questions. And that brings us to the end of today's session. And I'd like to thank our panelists for sharing their valuable insights on the topic, the organizers for arranging the session, and last but not the least, the audience for taking out time to actually attend this session. Have a good rest of your week and stay safe and take care. Bye.
Thanks so much.
Thank you, everyone.